I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our Following the Money podcast. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Today is Sunday, May 21st, 2023. Let's follow the money. Trend and tactical signals. The benchmark S&P 500 finished last week testing 4,200, which is the upper boundary of the sideways trading range it has been trading within since late 2022. The lower boundary is at 3,800. Our primary focus this week. The key to what happens at SPX 4,200 is big cap tech, which has been the primary reason that the S&P 500 has not fallen back to the 3,800 level, which is the lower boundary of its current trading range thus far this year. QQQ, which is the ETF that tracks the NASDAQ 100, has outperformed SPY, the ETF that represents the S&P 500, by 13% since January 20th, and that's really what's been keeping the broad market afloat. 4 key stocks to watch. Apple, Microsoft, Google, and Meta. Those are the number 1, number 2, number 3, and number 6 stocks according to market capitalization. Apple and Microsoft by themselves represent 15% of the market. They all are testing major overhead resistance levels. We highlighted these stocks and levels in our latest monthly investment compass chart book that went out to subscribers over the weekend. You can request more information about our premium services and pricing by visiting asburyresearch.com and clicking the Contact tab. These 4 stocks are all testing these really important levels. If these levels hold and drive the prices of those stocks back down, the S&P 500 is likely to move back inside of the 4,200 range, and maybe depending on what kind of pullbacks from these levels in those 4 tech stocks, may even move back to the lower end of the range. So that's the key. That's been the leadership this year. So what happens to those 4? Again, Apple, Microsoft, Alphabet, and Meta are really the key in our view to what happens to the broad market between now and the end of the quarter. Sector selection, sector rotation. Our top 3 scores this week, according to our SEAF model. SEAF stands for Sector ETF Asset Flows. It measures the asset flows around the 11 sector SPDR ETFs, which together comprise the S&P 500. Those top 3 are technology, communication services, and consumer discretionary. All of those are risk-on offensive sectors. That suggests to us that the market is starting to lean towards a positive resolution to S&P 500 4,200. You could learn more about the SEAF model by visiting asburyresearch.com and clicking Models along the top of the screen. Size and style. Our CART model has favored large cap tech over small and mid cap since March the 10th, and growth over value since March the 28th. Both of these have outperformed significantly since then, and the relative trends remain intact. Finally, global asset allocation. Our U.S. versus the world model identified Mexico as an overweight on September the 13th of last year, and France as an overweight on October the 10th. These countries have outperformed by 24% and 23% respectively since then. However, these trends are currently being tested and may be coming to an end. There you have it. That's our Following the Money podcast for today. More information about Asbury Research, including our data-driven models like the Correction Protection Model, or CPM, and our SEAF model, which stands for Sector ETF Asset Flows, is available at asburyresearch.com. If you liked our Following the Money podcast, you can subscribe to it free of charge via the Asbury Research YouTube channel. This podcast is provided for information purposes only and is not intended to be a solicitation to buy or sell securities. The performance indicated from backtesting our historic track record may not be typical of future market performance. No inferences may be made and no guarantees of profitability are being stated by Asbury Research, LLC. The risk of loss of trading and financial assets can be substantial. Therefore, you should carefully consider whether such trading is suitable for you in light of your own financial condition.